They called me crazy when I said I wanted a 20% plus yield from my portfolio. They said it couldn't be done. They said it was too risky. But here I am sitting on a six-figure portfolio generating thousands in pure passive income every month. And today I'm going to show you how covered call ETFs are the secret weapon that most normal investors are completely missing out on. Look at these numbers. While the average investor is begging for 2, 3, 4% dividends, we are collecting from 7 to 12% yields that hit our accounts every single month. Not quarterly, not yearly, monthly. Monthly cash flow that you can reinvest, spend, or use to build even more income. I've spent years testing and optimizing my strategy, and today I'm going to show you exactly which ones perform best, which ones belong in your portfolio, and how to use them to engineer a cash-generating machine that works in any market conditions. Welcome to Psycho Investor, where we don't just chase yields, we hunt them down and make them our own. I'm not here to tell you about your grandfather's 2% dividend stocks or those safe ETFs everyone recommends. Today we are breaking down the ultimate income vehicle, covered call ETFs, and not just any covered call ETFs, we are comparing the absolute best of the best, JGPE, JEPI, JPQ, and QILD. For those of you who are new here, my portfolio is sitting at over 100,000 euros, generating an average yield of around 28% annually, and these covered call ETFs form what I call the foundation of my Psycho portfolio, the stable, reliable income generators that let me sleep at night while also pursuing more aggressive opportunities. Let me show you my actual portfolio right now. You can see that covered call positions make up around 30% of my total holdings. This isn't a theoretical exercise, this is a real money generating real returns. In fact, let me show you my latest trades from just this week. Look at this. On March 3rd, 2025, I bought 100 shares of QILD at 17.46 euro, and now I own 1,800 shares. I'm literally putting my own money into these strategies as we speak. Before we dive in the specific ETFs, let's break down what a covered call ETF actually is and why it's such a powerful income tool. At its core, a covered call strategy combines two elements: owning stocks or an index and selling call options against those holdings. When you sell a call option, you're essentially giving someone else the right to buy your stocks at the specific price, the strike price, with a certain time frame. In exchange, you receive an immediate payment called a premium. Here's where it gets interesting. By collecting these premiums consistently, covered call ETFs generate significantly higher income than traditional dividend stocks. Let me tell you how this works in practice. Let's say you own shares of the Nasdaq 100 index trading at $400. You sell a call option with a strike price at $410, expiring in 1 month for a $5 premium. One of two things happens. Scenario 1. The index stays below 410 and the option expires worthless, and you keep your shares and the $5 premium. That's pure income generation. Scenario 2, the index rises above 410, your shares get called away, but you still keep the $5 premium, plus you make $10 from the stock appreciation, 410 minus 400. The beauty of covered call ETFs is that the professional managers are doing all of this for you, optimizing strike prices, managing expirations, and handling all the technical aspects so you can simply collect the income. But here's what makes covered call ETFs truly psycho. They typically perform best during sideways or moderately bullish markets. When stocks are going nowhere or moving up slowly, you're collecting premium after premium, generating income that traditional investors can only dream about. Now let's get to the real meat, comparing our 4 covered call champions. First up, let's talk about structure. These ETFs use different approaches that dramatically impact their performance. QILD, the Global X Nasdaq 100 covered call ETF, tracks the Nasdaq 100 index, uses at-the-money covered calls, and currently yields around 9 to 12% with an expense ratio of 0.6%. JPQ, the JP Morgan Nasdaq Equity Premium Income ETF, features active management of Nasdaq-focused portfolio, employs a flexible option strategy beyond just at-the-money calls, currently yields about 8 to 11% with an expense ratio of 0.35%. JEPI, the JP Morgan Equity Premium Income ETF, offers active management of an S&P 500-like portfolio, uses ELN's equity-linked notes for its option strategy, currently yields approximately 7 to 10% with an expense ratio of 0.35%. And JGPE, the JP Morgan Global Equity Premium Income ETF, provides global equity exposure across developed markets, employs a similar strategy to JEPI but with international diversification. Currently yields about 7 to 9% with an expense ratio of 0.4%. Now, here's what most investors completely miss. These aren't just different versions of the same thing. Each one serves a completely different purpose in your portfolio. Let's talk performance during different market conditions. In bull markets, QLD will underperform the most due to its at-the-money option strategy that caps upside almost completely. JPQ allows more upside than QLD but less than JEPI. JEPI captures more upside than QLD but less than the S&P 500, and JGPE offers international diversification that can shine during global growth periods. In bear markets, QLD provides premium income, but the Nasdaq exposure means bigger drops. JPQ's active management helps mitigate some downside, JEPI's lower volatility stock selection provides more downside protection, and JGPE's global diversification can help when US markets are struggling. In sideways market, QLD shines, generating maximum premium income. JPQ performs strongly with managed option premiums, JEPI provides steady income with less volatility, and JGPE offers consistent global premium collection. Now let's look at some real numbers. During the 2022 tech crash, QLD dropped approximately 23%, JPQ dropped around 20%, JEPI only dropped around 11%, and JGPE wasn't available yet. It was launched in 2023. But here's the psycho part. Even during these drops, they all kept paying monthly distributions. While regular investors were panicking about their portfolios being down, we were still collecting income every single month. This is what separates psycho investors from regular investors. We don't just focus on price movement, we focus on cash flow generation in all market conditions. Now let's talk about how to actually use these ETFs in our portfolios. Here's my psycho covered call allocation strategy. Core holding, JEPI. Why? JEPI gives us broad market exposure with active management and strong downside protection. This is our sleep at night position that keeps generating income in almost any market environment. Tech exposure, JPQ. Why? JPQ gives us exposure to tech growth with enhanced income. It's more volatile than JEPI but offers higher growth potential and often higher premiums due to tech volatility. International diversification, JGPE. Why? It provides global diversification that can perform differently from US markets. It's crucial for true portfolio stability. And maximum income, QLD. Why? It generates the highest premium income but with more downside risk and limited upside potential. We keep this position smaller but use it as our income turbocharger. Now let's talk entry points. For maximum effectiveness, dollar cost average into these positions over 3 to 6 months rather than dumping all your money at once. Increase allocations during major market corrections when premiums are higher. Rebalance quarterly or monthly to maintain your target allocations. Reinvest distributions to compound your income stream over the time. And for European investors watching this, all 4 of these ETFs are available on many European exchanges. Just look for the UCITS versions. For the JP Morgan suite, look for the equity premium versions available in euros. Remember, tickers might be slightly different depending on your broker, but the underlying strategies are essentially the same. Now let's talk about how covered call ETFs work with the rest of our portfolio. I call this the barbell strategy. One side of your portfolio has these covered call ETFs generating reliable monthly income. The other side has your higher growth, higher risk positions like our TQQQ or TSL3 and Max positions we've discussed in previous videos. Just look at my own trades from the past week. While I was buying QYLD, SPY, QQQY for stable income, I was also adding to my TSL3 EU position, buying 10 shares at 19.30 on February 27th. And another 10 shares at approximately 23 euros on February 26. That's the barbell strategy in action. Income generators on one side, growth rockets on the other. This balanced approach gives you both current income and explosive growth potential. It's the perfect hybrid strategy that most investors completely miss. Looking ahead, what can we expect from these covered call ETFs? First, in a high interest rate environment, option premiums tend to increase, which is actually beneficial for covered call strategies. This is counterintuitive to most investors. When rates rise and regular income investments struggle, covered call ETFs can actually generate more income. Second, with market volatility expected to continue through 2025, these strategies should continue to generate attractive yield. Higher volatility means higher option premiums, which translates to more income into our pockets. Third, the JP Morgan suite, JP, JPQ, JGPE, continues to attract massive inflows, which gives them more resources to optimize their strategies. Their active management approach allows them to adapt to changing market conditions, and so on. Now let's talk about optimal portfolio uses. For cautious investors, 25-35 years old, start with a larger allocation to JPY to build a stable income foundation. Add smaller positions in JPQ and JGPE to get comfortable with the strategy. For ambitious strategists, 35-45 years old, use all 4 ETFs in balanced allocations to create sophisticated income engine that generates consistent monthly cash flow while managing risks. For tech-savvy explorers, for example 25-40 years old, layer in JPQ and QYLD alongside more aggressive tech investments to capture both growth and income from the technology sector. Now let's talk about the risks, because yes, there are always risks, and psycho investors manage them rather than ignore them. First, covered call ETFs will underperform in strong bull markets. This is the trade-off for enhanced income. You're essentially capping your upside potential in exchange for consistent cash flow. Second, these ETFs are still subject to underlying market declines. QYLD and JPQ in particular, with their tech exposure, can experience significant drawdowns during tech sell-offs. Third, there's always the risk of distribution cuts if market conditions become extremely unfavorable. Though, historically, these funds have maintained attractive yields even during difficult periods. Here's how I manage these risks. Position sizing. Keeping allocations appropriate to each ETF's risk profile, diversification across different covered call strategies, regular monitoring of performance and distribution sustainability, having cash reserve to add during major drawdowns. The key is understanding that these aren't set and forget investments. They are tools in your income-generating arsenal that need to be monitored and adjusted as market conditions change. So there you have it, the complete psycho guide to covered call ETFs. We've broken down JGPE, JP, JPQ, and QYLD, shown you how they work, how they perform in different market conditions, and how to implement them into your portfolio. Let's recap the key points. Covered call ETFs generate enhanced income through option premiums. Each ETF has different exposures and option strategies. They perform differently across market cycles. Together, they create a powerful income foundation. This is exactly how I've built my foundation for more psycho strategy. These covered call ETFs provide the stable base that gives me the confidence to pursue those 50 to 100 yields in other parts of my portfolio, QYLD to be exact. Now I want to hear from you. Which of these covered call ETFs are you currently using? As you can see from my trading account, I've just added QYLD EU this week because I believe the current market conditions are perfect for covered call strategies. Which ones are you planning to add? Drop a comment below and let me know your thoughts. If you found this breakdown valuable, smash that subscribe button and hit the notification bell so you don't miss any of our future psycho investing strategies. We are talking about life-changing yields and portfolio construction techniques that most investors will never discover. Remember, while others are satisfied with mediocre returns, we are building income machines that could potentially set us free. This is Psycho Investor, and I'll see you in the next video. Stay psycho, stay profitable.